Good afternoon, everyone. Thanks so much for coming out. Really do appreciate it. It's great to have a great crowd today. As you know, I've been doing webinars for the last couple of years, so it's really nice to connect and reconnect and see people in person and run through the fund itself. So what we're going to do today, we're going to, there's a number of different angles we're going to run through today. So effectively, we're going to talk about the fund philosophy in terms of just recapping on the fund. But before that, we're going to run through the global mid-small caps and how we frame it and how we look at what we're, the size of the companies that we're looking at, just to help with the conversation today. Then we'll talk through some of the current positioning, some of the current issues in the market today, which are plentiful. And we'll talk through 5 of our biggest positions. And hopefully that'll give you a flavor of how we're positioned today and going forward. And you'll come away from this thinking, these businesses are very high quality and strong secular growing businesses as well. And keep in mind, when we're talking through those top 5, we'll cover about a quarter of the fund. So we're covering a lot of ground just in those 5 names alone. And then we'll finish off with performance and hopefully leave plenty of time for question and answers. So firstly, the global mid-small cap market. Global mid-smalls, when that, the name of that for me just kind of has that vein of, small micro-cap companies where they're actually not. And what we have here on this slide is just some of the Australian companies as relative size and scale of what they are. So you look at Cochlear, they're just under 10 billion US in terms of market cap. Stockland and Qantas are just $6.5 to $7 billion in terms of US dollars market cap. Now we own Bureau Veritas, $12.5 billion market cap. They're one of the top, there you go, one of the top testing, insurance, and certifications companies globally. PTC, another $12.5 billion company. When you have anything designed, say it could be an airplane engine, could be even this laptop, it could be designed on PTC software. $12.5 billion market cap, 4 in the world that do that. And finally, Sensata, they're just under 7 billion market cap, one of the leaders in critical mission sensors. So if your tire pressure goes off in your car, odds are it could be a Sensata sensor inside that wheel making that happen. They have a real strong growth driver behind them as well with electric vehicles where content per car is doubling over time as well. So what I want to do is just show that these, Cochlear, Stockland, Qantas are considered large companies, very safe companies, and probably in many portfolios. Well, when we talk global mid-smalls, we got companies that are actually twice the size of them. And in terms of where they're positioned, they're multi-billion-dollar market cap companies and typically operate in very strong secular growing markets. So I hope that just gives you a flavor of what we look at when we talk global mid-smalls. And the other benefit is that there's a lot more to choose from when you look at the overseas opportunities. You look at the right-hand side of the chart there, there's thousands of companies offshore that we can look to invest in. One of Warren Buffett's phrases is, don't follow the herd. All that really means is just be aware of your concentration risk. And if you look at the Australian market, 50% of the market in financials and materials, that's basically your big 4 banks and BHP and Rio. So a massive amount of concentration risk there. Overseas, you get exposure to different technology opportunities, consumer discretionary, healthcare, many different industrial applications as well. So I find when you look at overseas, there's just a massive diversification benefit. And the beauty is a lot of those companies are very undercovered. Believe it or not, even though they're multi-billion-dollar cap companies, you're dealing with the Apples and Microsofts of the world, which are trillion-dollar cap companies. So there's a massive opportunity for us in terms of the price discovery strategy, which we have, and we'll talk through that in a bit, that gives you that benefit or efficiency offset that we can put into the fund today. The other thing that I like about the global mid-small cap opportunity is it's not that well invested in. I wish it was a lot more invested in, don't get me wrong. I think when you think of your Australian portfolio, you got a decent exposure to large, mid, and small caps likely. I think there's a lot of exposure to global, but more in those mega caps, your Facebook and Alphabet and Microsoft. But I believe there's very little allocation into this global mid-small cap area, and it's a real missed opportunity cost, I believe, because these companies are typically growing as fast, if not faster, than a lot of those mega caps and trading at half the multiple. And for me, that's a great setup. And when we go through the 5 names, I think you'll see that show through in spades as well. Now, just touching on our philosophy and how we look to invest. So the tagline is connecting to tomorrow's returns today. All that really means is that the market is generally very efficient. And you may not think so when you see stocks go up and down 20%, but the idea is that the market is quite efficient. It isn't, though, when a company's going through a period of change. And a high-quality company, when it's going through this period of change, creates a price discovery opportunity for us to get in at a great price, and then be in that company at a very discounted valuation to its intrinsic value, and hopefully compound that over time. So that's what we mean by connecting to tomorrow's returns today. But let's talk through some of the main tenets of the fund itself. So it's fairly concentrated. 20 to 40 stocks is generally our range of where we look at. It typically falls around 30 stocks is kind of where the sweet spot is. I find when I get down to 20, I'm taking on a lot more of that concentration risk. Get up to 40, and it's really hard to put your hand on your heart that you know those businesses the way you should. Like I mentioned, we have a mid-small cap bias, so the way we describe that is US dollar 15 billion and below. So mid-small cap at 15 billion US, that's a top 30 stock on the ASX, same size as Newcrest. So these are big multinational companies. And I know I keep harping. Yeah, sorry. I'm sorry? Yep. No, there wouldn't be. There was one Keysight, but that's the only one that was in there. We don't own that at the moment, but we have none in the S&P 500. Yeah, that's exactly right. And these ones that I'm talking about are actually almost twice the size of those. They're almost twice the size of some of those companies that we talked about. Like, so you think of Qantas, it's like a $7 billion market cap company. PTC is $12.5 billion market cap, so much bigger. And it's been this 5-year education process for me to tell people what global mid-small caps are overseas. And the difference is you're dealing with trillion-dollar cap companies, $1 trillion of market cap companies. So overseas, a company that has like a $10 or $20 billion market cap is viewed as a mid-small cap overseas, where domestically that might be $1 billion or $500 million. So there's a big difference. Yeah, so that's a great question. So the average market cap of my fund is $7.5 billion US dollars, $7.5 billion US. So if I was to put that on the ASX here domestically, it'd be a top 40 stock if I was to put that on one stock. So that just shows you the scale and size of these businesses. Yeah. And I have one company that's as big as Telstra, and we'll talk through Cellnex in a bit. Yeah. That's okay. And I think if anybody wants any questions, just raise your hands and we'll keep it quite casual. Thanks for the questions. And in terms of our other attributes that we like, absolute return focused. So I managed money for a family office in Melbourne for several years, and the tenet there was make me money and don't lose me money. That was the end game. And what we tend to do or like to do is look at growing that capital with an eye on that preservation as well. And that comes through knowing your businesses incredibly well. I think that's the best way, or the best way you can manage risk, is knowing your businesses. And finally, contrarian. So it's not contrarian saying I'm a value player or I'm a growth player. It's really contrarian saying, okay, companies are going through this price discovery opportunity. Let's do the work. Let's invest the time in holding it to make sure it comes to those catalysts that we're looking for. But I find contrarian is more about patience. So it's patience about saying no to pretty much everything that we're looking at. But patience is more important in terms of holding. And a lot of our names we've owned for 3-4 years. And I hope I can own them for decades, as long as those businesses are performing the way we like them to. And when we go through the top 5, I'll tell you how many years we've held those names, and they're still the biggest positions in the fund. So that's what I mean by contrarian. Now, I talked about the price discovery a fair bit, and I just wanted to touch on some of the bubbles there. And the first one there you see at the top is the post-IPO. Let's face it, if you're going to list today, you're probably not going to do that great, how weak the markets are. So that gives you an opportunity. The second opportunity is those companies that list, typically it takes a while for the market to understand what they are. And that gives you a great window in terms of investing in those businesses. Corporate restructure, that's the best one. So corporate restructure, spin-offs, that's when the company's going through this change. They might sell an underperforming asset, or they might spin off a smaller asset. And typically a lot of the big funds out there won't own that small asset. And that gives you an opportunity to buy that business at a great price as well. Fallen angels, yeah, in this market, pretty much everything's a fallen angel. But I find the best fallen angel opportunity right now is your own portfolio. You know those businesses incredibly well, and you add to what you know. And that's what we're doing at the moment as well. Management change and embedded optionality, those are two last ones. Embedded optionality, we'll touch on Flex in a bit, and you'll see what I mean by embedded optionality. It's just about having this core asset in there. a little jewel that the market's really not valuing the way it should. Now to the positioning considerations. A lot of good news in the market today. There's a lot of strong currents. You know, I'm being facetious on that. There's a lot of negativity in the market today. So there's a lot of inflation concerns. So everyone and everything is going up in price. So you have commodity cost increases, you have supply chain really limiting the ability of companies to get efficiencies coming through. Wages are going up as well. And the question now that the market has, are we peaking inflation and we're going to start to roll over? I believe we will. I don't believe we're going to sustain inflation increases from here. The question is, where do we settle down to? And we'll settle down to a level higher than we have in the past. I think that's a given. And the central banks of the world, one of their tenets is price stability. And with price stability, they need to keep a cap on inflation. So that's why all the central banks of the world are raising interest rates. You know, Chairman Powell in the U.S. is raising rates 50 bips probably the next couple months. And he's also doing quantitative tightening, which is taking liquidity out of the system. He can control demand, he can't control supply. So right now he's trying to limit the demand so supply can catch up and hopefully bring those inflation numbers down. The pandemic, you know, it's amazing to think of March 2020. I was in the U.S. that week when it really hit, and we're still dealing with it. You know, China's in lockdown, Shanghai. From what I read this morning, actually maybe June the 1st, you might open it up a little bit, so that'd be great. But that's still impacting supply chain, still impacting demand as well, so that's lingering. And the atrocities in the Russia-Ukraine war, you know, that's really shone a light in terms of security of energy. So the cost of energy has gone up, but I think the security of energy has gone up even more. So where does Europe get its gas from long term? Where does it get their energy from? And if you notice, even domestically, Fortescue with Andrew Forrest, he's talking about investing $50 billion in green energy to ship to Germany. And we're going to see a lot more of those green energy projects being built, and we're playing that through one of our companies as well. No. Yeah, and I'll touch on the. I do. I do. So I have an ESG overlay, and I screen oil and gas out, mining out, and yes, yeah. And I'll touch on that. Well, hydrogen is actually a green hydrogen source of energy. Yeah. So actually, that's a good source of renewable opportunity. Oh yeah, sorry. More questions? So it'd be more manageable if there's one or two of these things happening at once, but we've got all of them at the same time. So it creates quite a challenging environment. Probably the most challenging environment I've seen in my investing career in terms of everything happening at once. And all these issues are creating a lot of growth concerns, clearly. Now, the thing is, I'm not going to answer any of your questions in terms of where it goes, but what I can tell you is that the future is unknowable. And the other aspect of that is that, you know, when you think about it, did anybody have the pandemic on their radar? No. It became a defining event in our lives. So that's why it's very hard to predict where things are going. So that's why you have to be conservative where you're investing in your approach. But one thing I will say, over the last decade, there's been a generation of investors that have been really focused or, you know, investing in a market where you've had low inflation, low growth, and low interest rates. That narrative has flipped. So now we have an inflationary environment, rising rates, and that's created a new investing climate. And there's a lot of those growth names, you know, those concept stories that have been hit pretty hard in the back of that. So the market now is not pricing those long-term earnings. Like when you discount something at 0%, you can make anything work. Rates are going up now, so those long-term earnings are being discounted at a higher rate. That means those numbers are coming down, and that's not done yet. The market is really focused on near-term earnings, cash flow, strong balance sheets. And if you look at my sunny side of the chart there, so that's where you want to be positioned right now. So you want to be conservative. Our portfolio is quite balanced. Like I said, we can't really predict the macro, so we want a portfolio that can participate in most macro scenarios. And we're very focused on the risk, and that's understanding our businesses, really getting on top of them, understand where those risks are in the businesses. You want a very strong balance sheet, and cash flow is underpinning that balance sheet as well. Just last week, there's a company in the U.S. called Carvana, which is an online used car dealership. They tried to raise $3.3 billion of debt. They couldn't get it done, right? So they had to have private equity come in to take down half of it just to get that deal through. So you do not want to have a balance sheet where you need to refi in a rising rate environment when you've got liquidity coming out of the system. And hopefully you'll take away from our names that they have very strong balance sheets and cash flows. Valuation support, incredibly important. As I mentioned, you know, when discount rates are going up, multiples come down. So you want to have a situation where you don't have that risk of a multiple going from 30 times down to 15. If you're in that mid high single digit rate or low double, you're probably set up pretty well, as long as you can get confidence around the earnings. And for mine, tangible assets with pricing power are becoming incredibly valuable. So you think of the commodity costs going up, wages going up, the cost to make things has just gone up dramatically, if you can get it done. And if you've got pricing power, those tangible assets have just become 40, 50% more valuable. And we'll touch through WillScot in a little bit, and you can see what I mean in terms of those tangible assets. And building on conviction, it's all about, like I mentioned, right now, your portfolio is your best watch list in terms of adding to. And we look to build on our existing positions and grow them in terms of their size. So that's the positioning considerations. There's a lot of unanswered questions. You want to keep the portfolio very tight in terms of the positioning around that, and you want to make sure you have the balance sheet, cash flow, and valuations in place. Now, the other side of the coin is more bigger picture stuff in terms of what we really look for when we're looking at businesses. So for mine, simplicity and focus, especially when you have a market today that is so volatile and uncertain. You want to have simplicity and focus, and the focus is about knowing your businesses. I know I keep harping on that, but that's the best level of risk management, is knowing your businesses. Making sure they have long-term growth prospects, making sure the management team is working for you and their customers and their employees as well, and making sure you're in there at the right price. So that's what I mean by simplicity. It's making sure all those tenets in place. And when you think of the attributes which really underpin that, it's the secular and structural growth stories. Businesses that can grow their revenues irrespective of the market. They may be in data growth, they may be in net zero opportunities, but if they can grow their earnings and revenues over a period of time, in 2 years, 3 years, they're going to be a lot more valuable than they are today. So one thing for me, you can't call the next 2 months, 3 months, but these businesses, they're going to be a lot more valuable as long as those earnings are growing over the next few years as well. And what really drives that? So you've got high or growing market shares in very large addressable markets. When you think of our names, and many names, they have hundreds of billion-dollar addressable markets that they're operating in. If they can grow that market share in those markets, it's a massive driver of earnings growth for these businesses. High customer retention rates and high levels of recurring revenue. For me, that just shows the value of the goods or service that they're offering their customers, and they keep coming back for more. We've had a number of our companies actually take on more inventory onto their balance sheets. They had the ability to because they had strong balance sheets, but they took that inventory on to make sure they could service their customers. And what that has done, it just entrenched the loyalty of their customer base, which has been fantastic. Pricing power, clearly in this environment of inflation, you want to have pricing power. You want to be able to pass through those prices and not be that weak link in the supply chain. We've seen a couple big retailers the last couple nights come off. Target last night was down 25%. Why? Because they couldn't pass on the prices the way they should, and they're wearing a lot of freight and logistics costs. So you want to make sure you have that pricing power without destructing demand. That's the other side of the coin as well. You can raise prices, but if you lower demand, then that's not a great situation to be in. But if you can have the opposite of that, which several of our companies do, then you're in a really good situation. And clearly companies that are doing good. So we love to own businesses and make money from them, but if you can have a business that's benefiting from recycling, it could be helping the movement to net zero, or just simply companies that are doing good. It just feels good to own those style of businesses. Now you flip that coin around, and what do we look to avoid? Well, clearly, companies that do harm. We want to have a positive ESG backdrop to the portfolio. We're avoiding concept stocks. Like I mentioned, those businesses typically have earnings way out in the future, and those earnings have been discounted pretty dramatically today. And as rates continue to go up, those earnings will probably be discounted even further. So I believe there's probably still more to go with those concept names. Questionable management. You want a management team that's working for you or us as shareholders, but also for the customers, their employees, because if they're not happy, we're not going to be happy, and they're not making profits. So we've got to make sure the management team's working for everybody. Disruption candidates. I think a lot of the disruption's been done in terms of, you think of newspapers and videos and the like with Netflix and online newspapers. But I believe the next disruption comes from costs. So we've got a few companies that are helping take costs out of the manufacturing fleets, out of supply chains, and that's where the next disruption comes from, is taking costs out of the system. And clearly low growth attribute companies. It's very hard to compound earnings or compound returns if your business isn't growing. So we want those businesses that are in those secular and structural growth. So that's a bit of a flavor of simplicity and focus that we look for and look to invest in terms of the companies that we've got. And this is the barbell. So The barbell I've been talking about for a while now is just trying to demonstrate, in terms of the positioning where we are. This is every company we own. So one thing that I like to do is be fully transparent in what we own so that you as shareholders can have confidence in times of market stress of what's inside the portfolio. So on the left-hand side there you have the value. And my problem is what's value anymore? So we'll touch through WillScot, we'll touch through Assurant. They're growing at mid-teens, yet they trade at value level multiples. So probably best to think of value as companies that are consumer discretionary, financials, more in the industrial space as well. And you get companies on the right-hand side, more your secular growing markets. They might be companies that are benefiting from data growth. Data's growing at 25, 30%. And I believe that's actually going to accelerate from here. We've been streaming Netflix and YouTube, and that's been driving data growth, but now you're going to have machines talking to each other. You have the autonomous cars, you have the manufacturing fleets. They're all going to be enabled. And that's going to create a lot of data growth over the foreseeable future. And that's going to be underpinned by 5G. You need infrastructure to make that happen as well, so that's the way we like to play them. It could be companies that are really driving the move to net zero, like Chart. So Chart has 60% market share, and that's one of the hydrogen companies. 60% market share of storage, production, and transportation of hydrogen. They're one of the leaders, well, there's 60% market share in North America, around 40% in Europe. Massive opportunity there, and there's a lot of money being spent on security of energy, and they're a key player in that space. The mix of them now is roughly 60% on the value side, 40 on the growth side. Rewind 12, 18 months ago would have been flipped the other way. I don't manage to say I want to be 60 or 40. It's just where the opportunities are and where we see those opportunities for the fund. So that's the barbell. And what we'll do is talk through the 5 biggest positions that we've got today. And I hope what you take away from this, when you cast your mind back to the stock attributes, structural, secular growing markets, high market shares, great management teams that are driving this, customer retention very high, recurring revenues, balance sheets and cash flow. Keep that in your mind as we're running through these names. So our biggest position today is Assurant. So it's just under 10 billion market cap, trades at 11 times PE. So what is Assurant? So they are one of the leaders globally in protecting and securing some of your bigger consumer purchases. So you think of your mobile phone, you think of your car or your house, they provide protection on the other side. So as an example, let's say you went into an Apple store and bought an iPhone, a 5G phone, and you wanted to put a protection package on that as well. Well, that'll be likely Assurant that's providing that protection package on the other side. As we move to 5G, you got a massive shift, a secular shift in terms of a refresh cycle coming through. And those phones are a lot more pricey than the 4G or 3G phones that they're replacing. With that, you're getting higher attachment rates. So you have a structural growth opportunity there as well. In auto, so if you are looking to extend your warranty on your car, or let's say you're doing insurance on your tire rims, that's likely Assurant on the other side of that's providing that insurance for you. So they have roughly 50-50 market share between used and new cars. So really they're agnostic in terms of if we're shortage of new cars because they can get it on the other side with the used cars. So they get that benefit too. In housing, what I like about the business, they have a counter-cyclical aspect to them as well. So what they do, they track over 50% of all mortgages in the U.S. So if you have a mortgage in the U.S., it has to have home insurance on it. And they track to make sure the customers, so the consumers, have their mortgages up or the home insurance up to date. If they fall behind, let's say they lose their job or something terrible happens and they fall behind and go into arrears, the bank enlists Assurant to put that home insurance in place, and they pay Assurant for that. Now, the thing that I like about this business, or hopefully they don't get to the levels of GFC, but it's making about 1/3 of what it was back in the GFC. So it's a good optionality, good counter-cyclical opportunity then from a housing standpoint. So they have this long-term secular growth from connected devices. And we'll touch on that on the next slide a little bit. But you think of the 5G, you think of smart watches. Now you're going to have the EVs, electric vehicles. They're smartphones on wheels effectively. And Assurant's going to be moving into that more as well. So they got a long tail of new opportunities for them from an insurance point of view. The other thing from this business is earnings growth. So they've guided 16 to 20% this year. They'll likely do another 14% next year. And they're talking double digit the year after that as well. They just recently had their analyst day to highlight all this. And the reason is their connected living, which is your mobile and auto, is growing double digits. And they can see that for the foreseeable future. Now, it's a capital-light business, so it's generating almost $3 billion of cash over the next 3 years cumulatively. Now, with their track record, the management has just finished a $1.35 billion buyback. I believe that they'll use that $3 billion and buy back more of their stock. But more importantly, they'll do more M&A in terms of the trade-in opportunity. So I did a blog recently in terms of the e-waste, and the amount of electric waste that goes in the landfills is just mind-blowing. Assurant is one of the leaders globally in terms of trade-in, refurb, and repair of electronics. And they're mostly in the US right now. They're actually here in Australia through Allegro. If you ever see Allegro, that's Assurant doing that domestically. And what they'll do, they're going to add to that capability on a global scale. And there's just a massive opportunity for them to really grow that when you think of all those new devices coming through as well. And it saves all that stuff going to the landfill. Like the natural resources, copper, gold, rare earths that are in these phones and laptops is just mind-blowing, and they can harvest that. So I like that long-term circular economy benefit for the business, and at 11 times PE growing at mid-teens, the setup I think is very attractive for this business. Now moving on to Graphic Packaging. So $6.4 billion market cap. They have operations here in Australia as well, and it trades at less than 9 times PE. So they are the world's largest folding carton manufacturer. So you think of the center of the store, you know, cereal boxes and Colgate boxes as well. That's what they do. So they do a lot of recycling, and we'll touch on that in a bit, and they repurpose that recycled material into these folding cartons. Now, they have 40% market share in North America, massive market share. It's basically a duopoly, and they do a third of all the paper cups in North America as well. So the paper cup side of things is quite interesting because they've just developed a water seal innovative product inside these paper cups where they're totally recyclable now. And they're getting a lot of new interest from food service companies to really roll that out. So this business has incredible pricing power just given the market shares that they have. And to put that into context, this year they're going to be putting through $850 million. It's already done. $850 million of pricing to come through. And given last year had such high commodity prices come through, they actually have a bit of a lag in terms of passing through. So net-net, they're going to add $200 to $400 million of earnings just from that pricing power this year. So you have the innovation coming through, driving growth, and that innovation comes from that shift from plastic to paper. You know, companies like Coke, Unilever, all these companies are under pressure from their consumers to say, we want to take plastic out of the system. Now, how do you do that? You do that with fiber-based packaging. And Graphic Packaging is the #1 player in the world, and that's why I really like the setup in terms of where they're playing in this. And they have this innovation pipeline, which is really driving organic growth. So when you put all this together, you've got a business that has the pricing power coming through this year. You have organic growth with this innovation pipeline as well. They've just finished a new processing facility in Kalamazoo, Michigan. I love saying Kalamazoo. And that's going to add another $150 million of EBITDA over the next few years as well. And you also have different productivity benefits coming through. So they've guided to double-digit earnings growth out to 2025. Next year alone, they'll generate over $700 million of free cash flow. So you got a business there with high market shares in a large addressable market, generating a lot of free cash. And I really like the setup of the business from that angle. Hi. Oh, yep. Here's the fiber-based, yep.
Right. Sorry, we're waiting.
You're preempting all my slides. That's okay. So here's a great graphic in terms of the fiber-based. It's tree-based. It's paper-based. That's fiber. Yep. Exactly. Yep. So it's just so we start with the managed forest, sustainably managed forest. That's where the virgin wood comes from, and then it gets made into virgin paperboard, as you can see here, and that'll get made into these cereal boxes, right? And those cereal boxes, I'm just keeping it simple, just saying cereal boxes. Could be any type of consumer packaging that comes out. So that can get recycled. Now, on this slide here, you can see those paperboard packages can get recycled 5 to 7 times. And the other angle around that is that almost 70% of all paper and paper packaging is recovered and recycled. So graphic packaging plays a big role in that whole circular economy. And why only 5 to 7 times? Because every time you recycle, the fibers get smaller and smaller, and you don't want to pick your cereal box up and have the bottom come out, so they can only be done that 5 to 7 times. And then it's repurposed. Now, domestically, if you go into Woolies, go into their meat section, and you see on the top there that rib fillet that's in that paper seal, you'll see that in the meat section. So what that is, it's a new product that they have, and compared to previous packaging, it takes 80% of plastic out. And that's quite an innovative opportunity they have. And there's one large U.S. grocery chain that's looking to roll this out across their whole fleet in North America, which is fantastic. So just an example of the circular economy, the benefits they add, and just a few of the products that they do as well. And that's creating that organic growth for the business.
The Australian company,
Very similar, yeah, but they're more in the corrugated space. So the Graphic Packaging and their competitor WestRock are more in the consumer packaging, where Visy would be more in the corrugated boxes, not in this type of product.
Oh, you mean they're in bigger boxes?
Yeah, more of those corrugated box, not consumer packaging as much.
Oh, not things in the supermarket.
Correct.
In other words.
Correct.
So Mr. Pratt and his Visy and all his expansion that he's doing in America is separate from that sort of thing, is it?
Yes, exactly. It's more, you think of Amazon deliveries, those boxes, those types of things. Yeah.
What, is he being innovative too or not?
I can't tell you. I don't know.
We don't know.
I'm sure he is. But yeah. So that's Graphic Packaging. Moving on to Flex Group. So Flex is one of the largest contract manufacturing businesses in the world. They have over 100 facilities, and that's around pretty much every geography. And that's incredibly important when you consider what's going on with supply chains right now. So what's happening? They operate in a $600 billion market, so a very large addressable market that they operate in. And another company that's recently had an analyst day, so they expect that market to grow 5 to 7% for the foreseeable future. So you have a $600 billion market growing at 5 to 7%. So that's a great backdrop in terms of a structural growth story. Now, why is it growing at that level? And it's actually stepped up from what it has in the past. And that's because these laptops, anything that's being produced globally now is getting a lot more complex. And a lot of the consumer companies really don't have the capabilities to manufacture it themselves. So they're outsourcing a lot more to companies such as Flex. And clearly the supply chain. So supply chains globally are under pressure. Flex has 10,000 supply chain experts sourcing components, making sure they're getting manufactured and shipped properly as well. So they're a leader in loosening up supply chain, and they're really benefiting from their capabilities in that space. So they have long-term growth. They have secular growing markets, and on the next slide I'll touch through them a little bit more. But it's all about that life cycle management. They're being drawn into more design. They're not just manufacturers anymore, they're designing these products along with their customers. What I like about it is that embedded optionality, if you remember some of those price discovery opportunities. So the embedded optionality here is a business they own called Nextracker. It's the largest solar tracking business in the world, roughly 30% market share globally in solar tracking. And all solar tracking is in commercial solar farms, is just following the sun to make sure they're getting the best efficiency from their solar field. And like I say, they have roughly 1/3 market share in doing this. So it's great to have embedded optionality, but you got to make sure that management wants to crystallize that, and they are. So they've actually lodged an S1 with the SEC to spin this off. And when market conditions are right, you'll see that Nextracker business being spun off as its own business. Now, in the meantime, we've had private equity invest in the business in February this year at a $3 billion valuation. So $3 billion for Nextracker alone, and you consider the market cap of this company is $7 billion. What you're doing, you're getting the rest of the business for roughly 3 times, okay? So that's that embedded optionality, and once that crystallizes, the market will understand, the value inside this business. In the meantime, we've got a business growing at more than 5 to 7% in a very large market. And I'll touch on why they're going to grow more than 5 to 7%. So they are really one of the leaders in next generation manufacturing. So you think of, electric vehicles, autonomous vehicles, the radar and LiDAR that's required for that. They're one of the leaders in manufacturing for customers, all the big auto OEMs. You have digital healthcare. One of my big drivers or big themes is at-home care. I believe at-home care is going to continue to grow, and for that you need smart, connected medical devices, and they are one of the big players in manufacturing these products as well. And finally with cloud. Cloud, like I mentioned, data is growing at 25–30%. And Flex is a big player in manufacturing a lot of the components required to make that work from an infrastructure point of view. So when you put those 3 businesses together, they're expected to grow 20% compound for the next 3 years. And the underlying business, their underlying industry growing 5 to 7. So they expect earnings or revenue to grow almost 10% for the next few years, and earnings growing mid-teens. Plus you got the Nextracker kicker when they spin that off as well. $7 billion market cap, trading at just over 7 times PE. This year, they should generate roughly $500 million of free cash as well. So you got a business here with a large addressable market, growing strongly and generating a lot of cash in the meantime. Now, Cellnex. So Cellnex is a company I've owned for over 4 years now. It's almost the same size as Telstra, or I think it's a little bit bigger than Telstra. And I know you said, Bill, you said that your number was 15 billion and below in terms of where you look at for market caps. It's very true. When we first bought this company 4 years ago, it was less than 10 billion market cap. And it's actually grown because of 2 reasons. One, the share price has done well, but secondly, they've been raising capital and buying mobile tower assets in Europe. So the largest independent owner of mobile tower assets across Europe, roughly 20 to 25% market share of all towers are owned by Cellnex in Europe. Now, what I like about that, there's still an outsourcing trend coming. So a lot of the big telcos, they want to sell their tower assets to independent players like a Cellnex, and they have roughly $8 billion of available liquidity to do that still. And secondly, with 5G. So 5G densification, the towers become even more powerful. Fiber to the tower. You got to get that information to the tower and into the ground as fast as you can from a cost perspective. You know, when I think about Cellnex, though, you got almost 140,000 sites that they have. Try building that today, not just from a cost perspective, but getting the permitting for it. So from my perspective, these are irreplaceable assets. And when you think about these assets as well, they have pricing power. So they have roughly 20-year revenue contracts in place with the large telcos, and the majority of those contracts are indexed to inflation. So you have a natural inflation hedge. Almost 90% of their debt is fixed. So when you think about it, as inflation goes up and their debt's fixed, you got a really positive earnings profile there. And you look at the bottom graphic there, they've guided to 13% revenue growth, mid-teens EBITDA growth, and over 20% free cash flow growth up to 2025. And with this company and these types of companies, you can put hand on heart and say you're going to be at least that, because as of today, they have over 85% already done in terms of contracts. They're at a recent conference, and they actually expect the free cash to be higher at the high end of what they had said. So you got a business growing at that level, trading at 15 times. And like I said, I've owned it for over 4 years now, and it's the cheapest I've ever seen it. And I think it's because it's listed in Europe. But the thing that the market's forgetting is that this is an inflation hedge, and data growth isn't going backwards in Europe. Now, that 15 times multiple, keep that in mind. When I talk about a TPG here domestically, just sold tower assets to a Canadian pension fund for 32 times EBITDA. Now, I'm not saying 32 times is the right number, but it's a hell of a lot more than 15 times is the right valuation for this business. No. So American Tower is a lot more global. Yeah, American Tower, it's the three big independent players is Vantage Towers, American Tower, and Cellnex in Europe. And I'm glad you brought it up because there's a process going on with Deutsche Telekom, their towers to sell. And because American Tower has so much concentration in Germany, they're going to be ruled out. So Cellnex, knock on wood, is at the forefront of getting those towers. Sorry?
Asian market?
No, they're not. No,
So they're all Europe-based?
No, all 100% Europe, yeah.
Right, thank you.
And they have a lot of infill opportunity with Europe. So they're already, like, let's say with Italy and Spain and France, they're fairly full in those areas, and UK as well. But they're in Switzerland, Sweden as well, and they're going to infill a lot there in terms of growing. So it's 100% Europe. Yeah. And this slide here just shows the power of what they are. You know, the backlogs to the revenues incredibly strong, the ability to pay down debt. This is one of those businesses that I believe, from a pension asset point of view, is a really good setup right here in terms of matching those assets and liabilities. And finally, we'll touch on WillScot. So I've owned WillScot again for over 4 years. I hate to swear, but it actually came to life as a special purpose acquisition company, a SPAC. Right now, that's probably the worst thing in the market, but it actually came on the market at $10 roughly 4 years ago, and now it's in the mid-30s, so it's done quite well. It is the largest player of modular office leasing in the U.S., in North America, so they're roughly just over 45% market share. So if you drive by a construction site or a non-residential building site, 1 and 2 of those will have a WillScot Mobile Mini unit on that site. So that gives them incredible economies of scale. So if you look at the top chart there in terms of the North America, the density, they have to ship these things around. So the denser you get, the higher your barriers to entry are, and the more competitive moat you build over time. And they've got that now with 45% market share. They're doing small tuck-ins. They just literally bought one 2 nights ago in California, and do all these little small bolt-ons to really fill in that density, which is really important. They have fairly long duration leases, roughly 3 years is their average lease term, and incredibly strong pricing attributes. Now, right now, as of the last quarter, the current spot rate is 30% higher than what's being priced in the field today. So when you think about it, a 3-year average leasing term, roughly a third of the fleet will come back every year, and when that comes back that year, it gets repriced 30% up. Then you add value-added products to it as well. It could be a deck, it could be new air conditioning, it could be a 5G capability. All these value-added products are added, so that adds more pricing to it. The last several quarters have been growing pricing at 20%. Now, you say, Bill, well, how the heck can they grow revenue or pricing at that level? Wouldn't they get pushed back on? I think there's 3 reasons why not. Firstly, these are mission critical. So you can't have a construction site or a project without having the office site there. They're the dominant player in that space. They're typically first in, last off, and that gives them a long tail of that earnings visibility. The other angle I like as well is they're roughly 0.5 to 1% of the total project costs. So I used to cover Burns Philp back in the day, and I used to talk about yeast. So yeast was like a minimal cost of a price of a loaf of bread, but without yeast, you didn't have it. And that's a similar setup with WillScot as well. So they're a net inflation beneficiary. We figure they're trading actually below replacement costs today. One of their units, roughly $70,000 to replace, and they have over 150,000 of them in the field today. And then that's not even including the storage assets that they have as well. So management team there, incredibly strong. They've upgraded their guidance last quarter. They'll do roughly $850 million of EBITDA this year, and they've got a great line of sight to over $1 billion of EBITDA, $650 million of free cash, and you compare that to the $7.5 billion market cap, I think the setup for this business is incredibly strong. And this just gives you a better flavor of their scale, right? So they have roughly 120 million square feet of leasable space, and that's equivalent to 44 Empire State Buildings. But what I like about it, you can take those and move them to wherever your customer is. So it's incredibly flexible where you can put that capacity. And you look at those regional competitors, they're done in terms of the economies of scale and the barriers. And they're actually still buying some of those smaller players out there, so we're getting that a little bit of M&A benefit as well. So that's another business that we see, very strong secular markets, great cash flow, great management team with a very large addressable market that they're working in today. And now we'll just touch on performance. So let's talk about the 1 year, minus 4.4%. Worse than the market, not happy about being worse than the market, but I'll tell you why that's come to be in terms of the year-to-date performance. And it's been 2 reasons. One is hard to predict the Russian-Ukraine war on things, and what that has done is created a bull market in energy, mining, in terms of commodity chemicals as well, and we don't invest there. So that's 2 reasons why. Firstly, it's screened out from an ESG perspective, but secondly, it's not my core competency. So I won't participate in a raging commodity market. That's not where I look to invest in. I think you see with those names that they're not exposed to that. And secondly, with the consumer. So with the Russian-Ukraine war, we've seen food and fuel prices really drive the risk around the consumer and their spending intentions, and that's impacted the fund as well from the consumer. But when you think of the consumer today, probably the best wage environment we've seen for a generation, probably the best job environment we've seen, 6 to 7 trillion of home equity as well. So the consumer is going to slow down, but I don't think they will retrench as much as the market is implying. I always say, and I've talked to a number of you before the presentation, and you're watching the webinars, which I really appreciate, and I always say focus on the long term, and that's what I wanted to touch on here as well. Over the long term, we're ahead of the benchmark, and we'll knock on wood that we can continue that. What I'm more proud of is that we're ranking first amongst our peer group in terms of our strategy. And the strategy of buying high-quality companies that are compounding, I think, is working out. And I want to touch on the Morphic Ethical Fund as well. Very strong dividend stream in front of it. 6 cents annualized dividends in place today. But even more important is the coverage. So when you think of over 40 cents per share of dividends covered in terms of the profit reserve, that's just under 7 years in place today. So you're getting all these great companies, and you're getting a strong dividend stream underpinning that as well. And when you think of the stresses in the market today, hopefully you can take away that a lot of these companies have very strong earnings and cash flow behind them and valuation support, and you can get that dividend in terms of biding your time until they perform. And just finally on our differentiation, sorry, yes, sir.
Just in terms of the dividend, do you have a dividend reserve to support your dividend?
Yeah. So there's 40 cents, just over 40 cents of reserve, so just under 7 years in reserve. Yeah. So
I'm not sure I've got 7 years left.
the way the market's going, I don't know if I do either. But no, there's plenty of reserve in place.
Look, well done. I think your performance has been very good. I've followed the entity since it converted from a LIC, so well done. Look, a couple of things. Are you solo or do you have a few analysts to help you?
I've got my team here today, actually.
Okay.
So I've
Okay.
been building the team, and we'll look to build even more. So we got Kevin and Kelsey, who came across from the original Morphic team, and just hired Quinn Pearson, like literally in January as well. So I'm building that team up, and that's been the key pushback. The story's been great, the numbers been good, but we got to get that team in place, and I've got a great team behind me as well.
So are you all analysts or? Yeah, okay, fine. Look, Maura, thank you for that. I'm fascinated with general performance. Look, as you know, you can probably benchmark yourself more against the Russell than against the S&P.
Yeah, absolutely.
But the Russell is still above its pre-COVID high. So, arguably, it's not necessary, even though it's come off a long way, it's still above the 2020 pre-COVID high. Interested in your view on, just the general outlook for the Russell. But secondly, one thing I find is a good sanity check, which can be wrong for a long, long time, but is the Shiller cyclically adjusted PE model. Yeah. And while PEs are not particularly high at the moment, and your PEs are pretty modest, when you cyclically adjust them, they are still extremely high. And that's why if you go back to the S&P, 5 or 6 years, the index was 2,500. Yep. It's now 4,000. The Russell a while ago was 1,200, 1,300. It's now 1,700. So just interested in your views on the Shiller model.
Yep.
And looking at the chart of the Russell over the last 5 or 6 years. And final thing, well done. I think you've done a good job.
Thank you. I really do appreciate the feedback.
Thanks.
On the Shiller model, yep. So from my perspective, that's something that you go through these what are the mid-term earnings of a business and how cyclical are those earnings? I think that's what the Shiller Index does, is takes into account the cyclicality of those businesses. And that's why from my perspective, I look at businesses that do have those sustainable earnings. You think of a Cellnex, you think of the assurance and graphic packaging of the world. They got very strong sustainable earnings. They don't have those big peaks and troughs that a lot of companies that the Shiller Index will pick up. So that's something that, from mine, it's very hard to benchmark my fund against that, but it's something that really picks up. And that's where, if you look at, I'm going to dovetail the Russell with that as well. So if you look at the Russell, and I take your point on, but if you look at the Russell versus the valuations in some of those big caps still, there's still that safety trade on. If you look at the big caps versus what's going on with the Russell valuation, those big caps are still 80 to 90% over their 20-year average. So they're still very overvalued. And that's where you can see the risk coming through. The small caps are actually well below their long-term average. So I think from the Russell standpoint, there's going to be those concept stocks in there still. And those are where your real pain is going to come from. And that's stocks we don't have exposure to. But it's the bigger cap ones inside there, and the bigger caps especially, that's where your earnings, or that's where the multiple risk I think really is going forward. Yeah. But the Shiller PE, that's something that really does take into account the cyclicality of earnings, and that's why, from my perspective, we try to stay away from those deep cyclicals. And just to wrap up here in terms of our differentiation, so look, hopefully you can take away that the businesses we look at are high quality. We look at getting into them at a discounted valuation, just from that price discovery mechanism. And what I want to do is compound those businesses over time. So like I mentioned with Assurant, we've been there for 4 years. WillScot and Cellnex, again, 4 years. So you think those top 3 out of the top 5, we've been there for over 4 years. And transparency. One thing we've found in this environment is, I'd love to get your feedback on this, but the level of transparency is actually decreasing in terms of what people are disclosing. I want to tell everybody every month what we own, just so you can have the confidence in this type of environment that, that you have the certainty of what's inside this portfolio. And finally, to do that in a good way. We want to be responsible and try to give back as much as we can. So I appreciate all the questions as we go through, and hopefully we can have time for some more.
Between Morphic and Ellerston.
Yep.
Morphic, MEC is no longer listed daily on the stock exchange when you look in the newspaper and other things. What is the relationship when we bought initial shares and the float of Morphic?
Yep, it is
And
listed.
now we've got Ellerston, but
Yep.
it's not Ellerston Capital. It's not. What exactly are our shares in?
Mhm.
And I mean, it's all very well. I'm happy to see everybody still donating. It all sounds wonderful.
Yep,
But legally,
yep,
if all went haywire and I'm not happy about, you can hear my accent, I'm not happy about the U.S. I don't know where you're from, Canada or
I'm
Virginia.
Canada, yeah, so I'm good.
Canada. But I
Scared of
am
that
not
one.
happy about the U.S.
Yep,
of what's going on there and what has been going on there for the last 4 years, 6 years, and etc. So it's all very well, but I don't like it. I would, and I'm looking and thinking, why should we keep our shares
Yep.
in Morphic, and what's the connection? Are
Okay.
we?
Yeah,
Yep.
that's right.
So Morphic is listed, like it trades every day. It's listed on the stock exchange, MEC.
Well, it doesn't trade enough to get listed in the papers and on the main things. You've got to go in,
Okay,
and,
right,
and
yeah.
then it shifts to Ellerston. And if we look at Ellerston Capital, that's
Yeah, but if you went to the ASX website, you would see it there.
yes,
for
I
sure.
know
Yeah.
that's what I've been doing, but that's not. I'm still trying to ascertain the relationship, corporate relationships,
Yep.
and what we're getting. We're not putting money in a fund like units in a fund. If I hand over cash, buy so many units, we're investing in a management company that's deriving, according to this, a percentage fee.
Yep, yep. So
Now-
Ellerston as a group is the manager of Morphic Funds, who has its own board, separate board, independent board as well.
That's Packer.
Well,
Still Packer?
well,
Was
they
Packer.
have an ownership, but there's no involvement from the Packer family. So when you think of Morphic Fund itself, and think of what we just talked about today in Ellerston, I've managed both funds, and I manage them as mirrors. They're exactly the same fund. There's no difference between either one. So when we talk all the names here, they're all exactly the same names in both of those funds. Where MEC is a listed investment company on the market, and it might be too small maybe to be in some of the papers or something you look at, but if you go to the ASX website, you'll be able to see it there. Where the Ellerston Trust is unlisted. So it's a little bit different. Oh, yeah, let me go here.
An unfortunate logo.
Yeah, I know, isn't it? Yeah. So I can't comment on that. So here's the two funds here, but keep in mind that both are exactly the same from an exposure point of view. So Morphic Ethical Equities is listed, MEC is the code. So you get why you should stay there is the dividend stream. You get a nice 6 cents fully franked dividend as well, and it trades on the market. So those are the reasons why. And why should you be there just from an investing point of view? Hopefully some of the names there you liked, and that's part of the reason that I have confidence over the long term they're going to be worth a lot more in a couple years' time than they are today. So that's part of that capital point. And while we're waiting for the markets to repair themselves, which they will, then we can get a nice dividend stream along the way. So that's kind of the reasoning behind that. And the small cap fund, it's unlisted, so you just get distributions. You don't get a dividend from that. And that's the main differences between the two funds, just the structure.
Is it always going to be overseas and
Oh, it's gonna be
not
global.
in the U.S.?
Yeah,
Is it
so
never going to be here?
I can invest here. I can invest in Australia, but we've got a strong investor management team that already invests domestically. I want to give people exposure to global opportunities. So, but think of global, not just the U.S. So I'm in UK, I'm in Europe. I've got some in Japan as well. So I'm quite broad from a distribution point of view. So we have U.S., we have European exposures, we have UK exposure, we have Japanese exposures. It's quite a broad. And I quite like that because you got large addressable markets that you're dealing in, and you've got diversification globally, not just here in Australia as well. But the point around that is it should be part of a investment strategy, not just one. So you should have your Australian ones, you should have global ones, just as a nice mix.
Under Elliston?
Under
Elliston umbrella?
either one is me.
See, we don't-
Either one's
we
me.
don't
Yeah,
get all
yeah,
that.
yeah. So either one, they're exactly the same thing. Just a different way to different way to access them.
What are the returns? Oh, sorry. How do you compare how each of these is actually performing? I have MEC shares too,
Yep.
and I must say I'm puzzled, the same as my neighbour is, very puzzled. And when you put this one up, we're actually doing, for an LIC, we're doing pretty well.
So you can see from the 1 year, it's minus 3.3 to the end of April. 2 years, 12.4, and 3 years, 8.3, and inception 7.8. So those are the returns of the.
Yes,
Yeah.
yes,
And you got the dividend along the way as well.
yes,
That's,
yes.
that's where you get that dividend stream, which
Well,
Which-
my dividend's reinvested, so
perfect.
that's why
That's even
I'm-
better.
But that's
Yeah. Now's the
why
time you want to
I'm not
reinvest.
going to
those.
be here long term.
No, and you want to
You
know
got
that
plenty,
it's
you got
growing.
plenty of time.
Well.
Yeah. Yeah. But if you think of the way you think of the market situation today, you know, it's been a really tough market. But I look back at 2018, December 2018, the markets were down 20%. That was a really tough period. You look back at that, and it's just a little blip, now, because the markets will go up to the right over a very long period of time, as long as you're in those right businesses. If you're in those concept stocks, ones that have no earnings today, but they're promising them out in the future, I don't know if you're going to come back anytime soon. But if you're in businesses like we've got that are growing double digit, generating a lot of free cash, and very attractive multiples, I believe in the next several years are going to be worth a lot more than they are today.
Well, we can only believe that you are right, but
I try, yeah.
but I'm puzzled because all the stocks that were originally in MEC, including like Alston, is it?
Yep.
And there was a Japanese stock, and there was other stocks around the world.
Yep.
And have they all gone, or are they still in the fund?
So I took over Morphic Fund in October 2020, and there was a lot of ETFs in the fund, plus a lot of Chinese names in the fund. So what I did during that time, I said to myself, I can't run two different style of strategies. You've got to have focus in what you do. So I switched it all into the global mid small cap strategy with that. And in that situation, there were stocks in there that like an Alstom, who I believe were overvalued at the time. So I would have exited some of those. So I would have exited some and kept some. At that point, a fair few of the names were names that we put in ourselves as well. And it didn't take long to turn it over into a stock-specific fund. So
And so you got rid of the Chinese ones that you didn't like. There was a Chinese water company
Yep.
and a Chinese recycling company, I think, or wasn't there? Or,
So there was China Water Affairs. There's a couple different.
and there
Chinese
was a
names.
Japanese housing company.
A Japanese housing. company, yeah.
Housing. Remember that one?
Yep.
But anyway, so you reviewed all of them and gradually filtered a lot of them out, did you?
Yeah, I did. Yep. Wherever I
Yes.
felt I had the most conviction and wanted to have exposure to. Yeah.
Okay,
So, yeah, that's
yes,
all.
well, fair enough. But
Yeah.
I feel like my neighbour here that it's all terribly American. But have you said now that there are actually
Oh.
other investments, not all in North America?
No, it's not. So I've got UK, Europe. I got a Japanese company as well. But also remember, when you look at those American names, a lot of their earnings are offshore, and they have global earnings as well.
They are
So
global.
you think of PTC, 45% of that business is offshore. So
Well,
you
you
have-
see, when someone's saying they're unhappy with America, I don't know for what reasons, but I'm sure there are plenty of reasons. But, but looking to the future, they are saying, you know, with the inflation, after that there'll be a recession. And it doesn't sound, from the point of view of someone who doesn't know a lot about my point of view, it sounds a bit risky.
Yeah, so that can be global, that recession, and hard to, like I mentioned before, the future's unknowable. Who knows whether there is going to be recession? Typically, a recession is really caused by a financial systemic issue, where the banks in the U.S. are probably in the best condition they've ever been in, or led by a consumer. The consumer's in really good shape. So I think they'll slow down, but the question, the unknown question is, will there be a recession? Will there be a soft landing? And all that as well. But let's take a little bit of a step back on that front, because it's a very good point. So if you think of the top 5 names, so Assurant, I'm not saying these are recession-proof, but they are very insulated from potential recessions. So Assurant has that secular 5G trade-in opportunity, right? And let's say there is a recession. You also have this housing business. So that housing business is making 1/3 of what it was during the GFC, so it's a natural offset in terms of potential recession. Graphic packaging. I don't think anybody's going to not buy cereal or their Colgates going forward. They'll trade down, yet into private label. 20% of their business is private label, so they're going to get that anyway. So you got that recession benefit. Flex is probably a little bit more if you believe that innovation is going to stop and digital healthcare is going to stop, or we're not going to have electric vehicles and all that. That could impact them, but I believe that's a long-term secular trend behind that. And then you have Cellnex, which it's rock solid earnings. Like 85% of those earnings are done. They're already contracted today. That's what I like about those styles of businesses, because in general, you'll find from a secular or structural growing business, they can do it irrespective of the market. You know, the macro will impact them a little bit, but if you got earnings that are already underpinned, that's fantastic. And then finally on WillScot. So WillScot, from an infrastructure standpoint, they passed a bill in the U.S. just 6 months ago, and that hasn't even started to flow through yet. That comes through next year. So right now, from a non-residential construction angle, it's actually started to grow this year, and they'll get the more benefit coming through next year. Let's say it doesn't grow. They're still going to get 20% pricing come through, and that's that structural benefit that they have. And then you look at the multiples that we're paying for these businesses, like the high single-digit multiples, generate a lot of that free cash. That gives me that valuation support and confidence that they will do well, even in many different environments. And that's why I like that balanced portfolio approach in terms of the barbell, because I don't know what the macro is going to do, but I want to be positioned, whatever macro scenario comes out, that I'll benefit in some form with that.
I know Morphic has a pretty substantial performance fee, but you've got a catch-up clause in there. How much is left in the catch-up before you start to pay the performance
I wouldn't
fee?
worry about that anytime soon.
Yeah.
Yeah, there's a bit more to go yet.
It's like 30%. Like, did you not just have the number? Or
I'd have to get back to you. I don't want to give you one that's not spot on, so let me come back to you on that, okay? Yeah. Yes, sir.
In the mortgage, I see you're retaining dividend reserve. So that operates as an LIC, doesn't it?
Correct.
But the unlisted one, how does that operate? Does that also have dividend reserves, or is
No.
that so the payout is different?
Yeah, it's different. So it's like a distribution. So what you'll have every half year, you get a distribution. One half will be an income distribution, and the other half will be a capital distribution. So in December, you get an income distribution. So it might be dividends that I get paid, or we get paid from our companies, and that could be an income distribution. And then in June 30, we get a capital distribution from capital gains that gets distributed.
Yeah. So for someone who was considering which to invest in, what are the comparative dividend yields?
Okay, so there's really no yield in the trust. It's that distribution. And if there
Yeah.
weren't any capital gains or income, then it could be zero. Where
Yeah.
with MEC, you have that 6 cents done. Like that's in place.
And is there any franking?
Yes.
Yeah.
100% franked.
Yeah.
Is the LIC at a discount or a premium to
It's
the
at a
debt?
discount.
At what discount?
So the last NTA was $1.18.9.
How many?
$1.18.9
Yeah.
was the last, and the last share price, well, of this morning was $1.06. So it's about a 12 cents discount.
Right.
The way I like to look at it is you get that discount, and you get a portfolio that's got 25, 30% upside, so it's actually a nice little arbitrage there. Also improves the yield that you get. Exactly, yeah.
Thanks for the presentation. Just a quick question. I've noticed you mentioned circular economy and also ESG. So why is this so important now? What drives all this?
Why is circular economy important?
And
Yeah.
why is important, like from your point of view, right?
So
as
it's all
investors?
about resources. It's all about waste. You know, circular economies. You're going to hear more and more and more about it. So think of e-waste. 57 million tons of electronics gets dumped every year into landfills. Now, in that, you have copper, you have gold, you have rare earths. Why should we be dumping it in landfills? We should be recycling that. So that's circular economy. When you think of the papers that we talked about, the paper packaging, it's all that circular economy, reusing, repurposing. And it's just a matter of taking costs out of the system because we got finite resources. And when you think what's happened with Russia, Ukraine, there's been a real spotlight on where are my commodities going to come from and how are we going to use them efficiently. And that's why the circular economy is getting more and more important because that's what it does. It makes those finite resources that we have more efficient and you can reuse them more. So that's why I believe it's very important.
Bill, can you explain how you engage with the management of your invested companies and like how often you do it and whether it's direct, person to person or just how you do all that?
Sure, yeah, I think that's a good point because a lot of people say, well, you're based here in Australia, how do you get access to management over there? And before the pandemic, I used to go over about 2 months a year, traveling around and visiting them. Now it's more on the Zoom calls, but in terms of talking with management, we talk to them at least 4 times a year, one-on-one. So when they have the results, we'll talk to them after the result. There will be conferences as well where we have one-on-ones with them. I'm actually going over in June to meet with a lot of the companies that we have. So I'd say we talk to them one-on-one 5 to 6 times a year. And because you've been owning them for 4 years plus, you get very good access to the top management team because they know you're there, they know you're a long-only shareholder, and they want to maintain that relationship as well. So you think of Tim Boswell here at WillScot Mobile Mini. He had a little baby boy just 5 months ago. Those are the relationships you build over time with these people, and when you pick up the phone to them, they're gonna answer your call, and you get that. What I'm going to say is that you get that contact where you might not get if you, if you're more of a trading type of mentality, where if they know you're a long-term shareholder, long-only shareholder, they will take the time to help you get up to speed on their business. So I got to say the access to management is fantastic. I've actually got a couple companies that, like one company in Kelsey will laugh, XPO Logistics, like Tavio will email me at 5 in the morning saying you're ready for a call. Like it's just like, okay, Tavio, but it's great. It's good to have that in place. Yes, sir. So between the two funds, so roughly just under $200 million between the two strategies combined. 30 companies. Yeah, it's roughly 140-60. 140 in the trust and 60 in MEC.
Can you bring up that slide again of the two companies? Just wanted to see the fees. I think the fees are different. Just fascinated to see that if you have two companies that you're managing the same thing, they've actually got different fee structure.
That's a legacy. So that's a legacy. Both the funds were enacted before my time. Yeah. So it's more of a legacy between the two.
But is there any reason to perpetuate it now? I mean, you're doing the same work for both of those, I would think.
Yeah, that's a fair call, and that's a feedback we can give.
Yeah. It should. I know from all the other fund managers, they're pretty much the standard.
Yeah. One thing I will say, I think the trust is under.
But don't put. I was just going to say, don't put up the trust.
I think we should adjust the trust up, but that's not going to happen.
Yeah. Or meet in the middle, at least, somewhere. Yeah.
Yes, sir.
Is the structure influencing the variability of the price of MEC? It fell really fast, it seemed to me, over the last few months.
Yeah, that's a function of the listed investment company world. They typically do trade at a discount. MEC was doing quite well. It was catching up to the NTA. And when you go through periods like this, then the market creates uncertainty and what do you own, what's going on, and that creates that discount going forward. Liquidity is probably a barrier as well. There's a lot of bigger licks out there. It's not one of the bigger licks in the market, so the liquidity is probably a part of that aspect too.
And that would be influencing the buy-sell spread as well.
Yes, 100%. Yeah.
Okay, thank you.
Great. Oh, yes, sir.
Just a quick one, Bill. Do you actually do anything differently in the LIC to generate franking credits, or is it just exactly the same as what you do in the fund?
No, it's exactly the same. Yeah, there's no difference.
NTA discount? Is that, there was a lot of talk about trying to fix that up. Is that not an issue anymore? Or is it still an issue but not a soluble one? Or not?
Everything's soluble, solvable.
Solvable.
Soluble.
Solvable. Yeah. Is it
Everything's
solvable? That's the
solvable.
question.
Yeah, and that's something that we're always watching, and I know the MEC board's always very focused on that.
Yeah, I mean, all the other things you've tried, you know, high yield of dividend doesn't seem to do anything. So
Yeah. One thing I can control is the businesses we own, and hopefully over time that'll prove out. And I know the MEC board is very focused on making sure the shareholders.
There is a mechanism overseas where this doesn't occur, though. So do you see any chance of that happening here, like treasury shares? That,
well, there's also a mechanism here in terms of exchange-traded managed funds as well. There's different. You've seen a number.
But I'm talking about for the LICs particularly.
No, even no, right? No, that's something that I haven't explored.
Yeah, they do have overseas.
Yeah. Okay. Interested.
Treasury shares where they can prop up the price.
Okay. Okay. Thank you so much. All right, take care. Wow, that's a big applause.